Vancouver's housing market has faced prolonged challenges over the past few years, as you all know, creating a landscape that is far from ideal. But according to Ryan, change is on the horizon. So we're very fortunate to have Ryan, head of Vice President of Intelligence at Rennie, with us today to help make sense of how the macroeconomic forces have shaped our current market, and more importantly, perhaps, what we can expect moving forward. So please join me in welcoming Ryan to the stage. Thank you. Thank you.
Thank you. Thank you. Okay, it's working. Super. So yes, my title says Head of Intelligence. And I can tell you that my wife finds that fairly amusing. Before we get started, I want to thank Verna and Anne and the rest of the UDI board for inviting me to speak here today. And because I know it's not everyone's idea of a good time listening to the ramblings of an economist, thank you all for coming as well. Each of you actually has at your desk, I'm just used to saying that, at your seat there, the latest copy of the Rennie Landscape, the red book. It's almost literally hot off the presses. It's our fall 2024 edition of what is a semi-annual report where we look at all of the, or a variety of factors impacting our housing market here in Metro Vancouver. A big thank you to the intelligence and brand departments at Rennie for the production of this report. And then also a big shout out to Ryan Wise, who is the main man behind this edition of the Landscape. There's also a little table topper that you have there with a QR code. So you can scan that. Or you can go to landscape.rennie.com and you can access a digital copy of the report and other content that we produce every week. Okay. So, if you're not familiar with the gates of hell, which you may not be, it is a 250-foot wide hole in the desert in Turkmenistan that has been on fire for the last 50 years. So I guess it was the early 70s, there was a Soviet drilling rig that punched a hole in this massive underground natural gas cavern, and then all of these poisonous fumes were coming out of this hole, and nobody knew what to do about it. And they looked at each other, and I guess someone suggested they throw a match in to deal with it, and they did, and it's been on fire ever since. It's now a tourist attraction, actually. So what's amazing is that as devoid of life as you might expect the gates of hell to be, there's actually bacteria and thermophiles that are somehow able to survive the extreme conditions in the crater. And for me, this is a good analog for the experience of the real estate development industry in this region. Because I think for years now, break even has been the new profit. And I think Bo Jarvis said, I'm paraphrasing a little bit here, but we've been working twice as hard for half the return. Part of the reason that things have been so hard is inflation. So if we look back over the past 4 years, and let's assume that consumer price inflation has just been sauntering along at 2% a year, as it had been for 20 years leading up to the pandemic. If that had been the case, then over the past 4 years, consumer prices would have risen by about 8%, 8.2% specifically. What actually happened? This. Consumer prices rose by 18% over 4 years. So more than twice what we might have otherwise expected. And while that's ugly, I know there's a lot of you out there that might be quietly laughing or shedding a tear right now, because if in hindsight you could have taken development costs rising only 18% over 4 years, you probably would have done it, right? Instead, this is more like what your cost escalation has looked like over this period, and this is just the data that I have access to. I have no doubt that these numbers will look modest to some of you. On top of this rising cost environment, we've been dealing with an avalanche of policy interventions into the market, as we usually do. And honestly, it's very, very difficult to stay on top of it. It's literally part of my job and my team's job to stay on top of it, and it's very, very difficult to do. Certainly, some of these policies have more merit than others. Some are better constructed and conceived of than others, and some are truly impactful, but many are not, at least in terms of what they were envisioned to be doing. And that includes restrictions that are placed on short-term rentals throughout the province, policy that came into effect in May. So I want to show you this chart, and I just deliberately have scaled it from 0 to 100% to make a point. It's municipalities in Metro Vancouver. It's StatScan data. It's not my data. And it shows the percentage of the dwelling stock that is in short-term rentals. And you can see these percentages are small. If you look at the city of Vancouver, it's 2.8%. But I will point out that these percentages also include boats and hostels and barns and yurts and buses and caravans and windmills and lighthouses and tree houses and other things. So not all of these short-term rentals are suitable for long-term occupancy. So if we remove all of those types of short-term rentals and we just look at the short-term rentals that are suitable for long-term occupancy as a share of the dwelling stock, you can see these numbers are even punier. So in my mind, restricting short-term rentals isn't going to make housing materially more available, but it is going to inflict some unnecessary pain on many owners. Okay, all of this being said, I do love this quote. I'm not here to whine and complain today. The high-cost, policy-infused backdrop that we've been sort of working within, context that we've been working within, it's been the case for years in the past. It'll be the case going forward, for sure. So what I want to do today is focus on why things are going to get better for you. And after my conversation with John and Rick, I feel like we really need this. So that things are going to get better for you is something that I strongly anticipate, but it's not a statement without limits. And I think over the next 40 minutes, you'll get a better sense for why I feel this way. Now, Bob and I were out for one of our walks recently, and in addition to asking for my advice on artwork, as he does, he said to me, make sure you let everyone know up front where you're coming from. So I want to do that now so you understand my thinking and my biases and my principles. And certainly you're going to agree with some of the things I show you today, some of the things I say, you're going to disagree with some of it. But if I'm going to influence you in any way, your thinking on the stuff that I'm about to show you, then it's important for you to understand where I'm coming from. So let's start with where I'm coming from, these 5 principles that I'm working from at the moment. The first one is not my own, but I like it, that we have to study the past in light of the present for purposes of the future. In a nutshell, context is everything. Number 2, the economy sucks. Sure does, but it's not so bad that you should be worried about it at this point. It's just bad enough that it's gotten the Bank of Canada's attention. Inflation has been vanquished. And for me, inflation is like O.J. Simpson's football career. It's part of the story for sure, but it's not the story anymore. We're never going to be Calgary. And what I mean by that is we're never going to have enough land. We're not going to be able to build enough housing for the foreseeable future. We're always going to be more expensive than other markets in Canada. So those are just facts. That being said, things are about to get better, so I want to get to that now. So having said that, this is a funny slide to show. And I know this makes me sound like Ben Taddy. I don't know if Ben's here, but I think he'd be proud of me if he was here. So it seems like an unusual place to start, but I think if we're going to understand where we're going, then we have to sort of acknowledge where we're at today. And I want to open with a question here, which is distinctly non-rhetorical, and that is our economy suffering from boiling frog syndrome? So in other words, have things just kind of been getting a little bit worse all the time? We don't really notice day to day, but then when you look back, you go like, oh, right, things have gotten worse. It kind of feels like that. If we look back over the past 50 years, there's numerous instances where our economy has suffered acute trauma, if you will, in Canada. So we can go back not too far to the pandemic. We can go back to the Great Recession and the credit crisis, 08-09, the dot-com bubble bursting, a couple of instances of fallout from too tight monetary policy. But what we haven't experienced over this period, which spans half a century, so essentially the entire lifetime of a Gen Xer, is this grinding down of the labor market that we've seen most recently and that has taken place over the past 18 months. And make no mistake about it, it isn't just the unemployment rate that has gotten worse. If we look across a variety of labor market indicators in Canada over the past 18 months, those are the red bars, so things like employment, the number of unemployed people, the unemployment and employment rate, the number of people receiving EI benefits, the number of job vacancies, the job vacancy rate. These trends have been far worse than they were over the prior 18 months. And that prior 18-month period is the gray bars. So it's a lot of words, and it's a busy chart. So if I had to summarize this, this is what I would do. Okay? This is my take on our labor market right now. A lot of it isn't great. Wages rising faster over the past 18 months than they were in the prior. Good for individuals and households for sure, especially in a world that is getting more expensive. But for many of us in the room here as well, it adds to the cost of business. If we look at other things like the proportion of people that are in the labor force, that's the participation rate, or we look at the proportion of people that are working and supporting themselves and the people that aren't working, that's the employment rate. And if we look at that over 25 years, and we, on a monthly basis, and then we order it from lowest to highest, lowest being not good, and highest being good, we see that the most recent readings in Canada for each of these is at the bottom of the heap. Certainly demographics and an aging population plays a role here, no doubt about it, but none of these measures, whatever the reason is, they don't point to a virile economy here in Canada. Many of our go-to indicators of economic health also appear to be in better shape than they actually are because of insane population growth that we've experienced over the past couple of years. And so when we start to adjust some of these measures for the underlying population, they start to paint a decidedly less rosy picture. So that includes the participation and unemployment rates. It also includes real GDP. So in Canada over the last 2 years, GDP in aggregate has grown by 1%. But when you adjust for the size of the underlying population, it's actually declined by 3%. If we look at retail spending, I had to take it out to 3 decimal places, but it basically hasn't budged. Right? Even though our population's been growing, the total spending has not increased. When we adjust it for population, it's down 5%. And that's in nominal terms, so I'm not adjusting for inflation there. If we look at MLS sales adjusted for population, down 9%. In this market here in Metro Vancouver, we look across home types and values are still below their spring 22 peaks. So there's a bit of a recovery there, but prices still have not fully recovered, and that makes this one of the longest price reversions on record. So all of this, I hope you're not too sad, but all of this is exactly what the Bank of Canada has wanted in some form or another, right? They pumped interest rates to tame inflation, and then everything else became collateral damage. But in the end, they won what was effectively an existential battle with inflation. And how do I know that they won? Well, not only is the headline rate 1.6%, so that was really good news on Tuesday, following the reading from the prior month that was 1.95. So we have 2 months in a row where inflation is below, headline inflation is below 2%. But why do I think that they've beaten inflation? Well, we can look at it, we can slice and dice it in different ways. So one thing we can do is we can say, hey, well, what if we took out the mortgage interest cost component of the CPI, which is a very small sliver in terms of weight in the basket, but it punches above its weight because it's been rising by so much year over year. And there's an obvious feedback loop there between the central bank's monetary policy and the rate you're paying on your mortgage for the home that you own. So if we take that out, that one little sliver, we see that inflation is running at 1% for everything else. Then you can extend that further and you can say, well, what if we took out shelter? And you go, why would we do that? Well, you do it because one, it includes mortgage interest costs, but it also includes rental. And the rental component of the CPI is running pretty hot relative to what is actually transpiring on the ground. So that part of the CPI suggests that rents are increasing at over 8% per year. And I don't think anyone in this room actually believes, Wendy, that rents are actually increasing by that much. You know, at best, we're seeing very marginal upticks, but generally they've been flat over the past 12 months or declining. So when we take all of shelter out now, the price for everything else, from lemons to Lululemons, from horseback riding lessons to haircuts, so they tell me, prices are rising by 0.4%. So we are almost in a deflationary situation. And that is why we've seen 75 basis points trimmed off of the bank's policy rate since the beginning of the summer. I think it's important that you all recognize that even though we're down 75 points, that's great, it's good news. Rates are still restrictive. And they won't not be restrictive until they are in the bank's neutral range, where monetary policy is neither supportive or expansionary or restrictive. So the Bank of Canada does have a God, and it is 2.25 to 3.25%. So what kind of an impact have these rate cuts had so far? Because the reality is we have not seen much of an economic or a housing market response to the rate cuts that we've seen to date. By some measures, it's because the rate cuts don't amount to much. So if we look at a few different scenarios here. So this is a person who has a HELOC. They have a floating rate on that. They owe 100 grand on their HELOC. They're making monthly payments. So a quarter point cut in their rate reduces their payments by $21 a month. So you can take that and go to the pub and grab a beer and a snack, and there goes your savings. So, you know, obviously this is not going to move a market on its own. We can look at it differently though, and we can say, to what extent have rate cuts increased real income or the effective income of certain households? So think of, in this case, think of them as owners with adjustable rate mortgages, so where the payments move. So this is a household that can afford a benchmark home in the region, like 1.1 million-ish. They've got $900,000 outstanding. So a quarter point cut for them on that outstanding balance saves them $150 a month. You go, okay, well, I mean, that's something. It's a dinner out, maybe. But then you add it up over the course of the year, and you assume that the household has a blended, marginal tax rate of, say, 35%. It's just assumptions I made. Well, in that case, then, that quarter point cut translates to a $2,500 increase in before tax income. If you add up those three cuts, it's like this household got a raise over the summer of $7,500. And then finally, where we see sort of the biggest impact of rate cuts is on purchasing power. So in this case, we've got a household, think of it as a first-time buyer, a household income of $200,000. So two people each making 100 grand, reasonable. They can afford a payment of $5,300 a month. A quarter point rate cut, when their incomes are held constant, their down payment is what it is, increases their purchasing power by $23,000, or 2.5%. And as we get additional rate cuts, it's not a linear sum of that increase in purchasing power. It actually grows a little bit, but over 3 rate cuts, their purchasing power would increase by 70%, or $70,000, 7 to 8%. So that is material. Now we're talking, right? And we'll circle back to this when we get to the topic of future rates. Okay, I want to talk about next year, which if we get our way, in my opinion, it'll mean that inflation, interest rates, and home sales are average. I know that doesn't sound great, but it's a lot better than where we are. So let's talk about that. So inflation at 1.6%. Our forecast for inflation over the balance of this year and next is in the zone. It's in the bank's target range of 1 to 3%. One, the bank has incentive to manage it there. But 2, there's not a lot of economic tailwinds that suggest that inflation will really run away on us again. There's risk of deflation. But our baseline assumption is it's going to bob and weave, and it's going to stay within that 1 to 3% range. Now, I do want to point out here that that's good, but we don't see inflation, right? We see prices. And our world, as expensive as it is not getting cheaper. All this means is that everything's just going to get more expensive in a more moderate and predictable way, okay? So I just want to point that out because the effects of the benefits of lower inflation are not tangible on a day-to-day basis, but they will have a knock-on effect to interest rate policy. And right before we talk about rates, this quote is very apt, that in economics, things take longer to happen than you think they will, and then they happen faster than you thought they could. Previously, I've talked about interest rates taking the elevator up and the stairs down, but the Canadian economy has devolved enough that I think there's significant downside economic risk to not forcefully bringing interest rates down, and I do believe that the Bank of Canada recognizes that and will do that if necessary. So as we look at our outlook for the bank's rate, we do expect next week, so 6 days from now, a 50 basis point cut at that meeting by the bank. And then we expect as a baseline a 25 point cut at their December meeting. That could be 50. We'll see how the data evolves between now and then. But we see them settling in at 2.5% by midway through next year. So higher than the pre-pandemic interest rate of 1.75, but half of what our peak was earlier this year. And that'll be a pretty quick move if we get there, all happening essentially within 12 months. So with those rate cuts in mind, with the future rate cuts in mind, I want to revisit this purchasing power math. And we see by the end of next year, by the middle of next year, if we get those 10 quarter-point cuts, call it 250 basis points, that's going to translate to, for this household, an increase in buying power of $275,000. It's like half the price of a condo in downtown Surrey. So now we're talking, right? And this is going to be across the market. So we will see the cumulative effects of interest rates benefit buyers and benefit the market. And then the question becomes, because this will improve affordability, all else being equal, the question is, well, could price increases wipe out these benefits of higher rates for buyers? And my short answer is no, but I'll explain my thinking here with this overly detailed chart. So going left and right, you've got changes in interest rates, so higher to the right, lower to the left, and then you have home prices increasing going up, decreasing going down. And those circles that make a line represent all of the rate combinations and home price combinations that result in a constant monthly payment. So anything to the right of this and above it, any combination in there translates to less purchasing power. Anything to the left and below it translates to more purchasing power. We are right in the middle today, okay? Because I put us there. And if we look back to April, that's actually when we had peak unaffordability. So prices were a little bit higher. We had interest rates that were higher, just running off of the Bank of Canada's policy rate here. So the market is more affordable today for buyers than it was in April. And the question is, well, what about by the end of next year? Well, we talked about the bank cutting between 100 and 200 basis points. So that puts us on that side of the vertical line for rates. And I'll talk more about prices in a moment, but we certainly don't expect home prices to rise by more than 10% between now and the end of next year. So that creates a bit of a landing pad for us. That's that yellow rectangle. So that's where we think we're going to end up by the end of next year. And that is a more affordable market than we're seeing today. And an extension of this improved affordability will be increased sales counts. And I want to start with the resale market, and then I'll move on to the pre-sale market. So what you're looking at here, the red solid line is monthly MLS sales in this region. The gray line is what they would have been had they just followed long-run per capita average rates. Okay, so there's periods where we saw more sales than we would have expected, like in 2021 when we had almost 17,000 more sales than would have otherwise been expected here. And since then, we've seen, or we've realized fewer sales than would have been predicted by a simple long-range or long-run per capita measure. Now, as we look out to next year and we think about a lower inflationary environment, a lower interest rate environment, higher incomes, that will support sales activity. And we expect that sales in this region will converge with where they, quote unquote, should be by the middle of next year, which means that next year is going to look a lot like average with 55,000 sales. Won't be quite at average, but it would also represent a 40% increase in resales over what we expect for this year. If we look at prices, so Bob always says we can get you price or we can get you absorption, but we can't get you both. And our feeling is that over the next 6 months, we're not going to get your price. So just go back here. So currently, benchmark condo prices in this region are 3% below their May 2022 peak. And we expect them to increase on the back of everything that I just talked about to that peak by the spring of next year. To put this into context, here are other recent price downturns that we've seen in 08-09, much more acute and a fast recovery. 17 and 18, which bled into the pandemic, but it was a very protracted period of lower prices. And we're looking more like the latter. Prices have stayed closer to peak, but getting back to peak has proven to be quite a challenge. Now, the price gains that we see in resale are really important for presale because the groundwork for a well-functioning presale market is laid by a well-functioning resale market. Put slightly differently, if a resale market is not at least balanced, if resale prices aren't rising, it is unlikely that you're going to see, as far as homes sold are concerned, a lot of activity in presale. That segment of the market is going to be stuck in the mud. And that's what this chart essentially shows. So it maps, the red line shows benchmark price for condos changes in resale, and then the gray bars show presale counts. It's not a perfect relationship, but they generally move together. It makes a lot of sense too. One, the general public gets their information about the housing market from the resale market because the data is published so frequently, the media picks up on it, reports on it. So you go a few months of the papers, whatever they call them now, reporting on price increases, and we all suffer from recency bias. What we see then is the expectation that prices will increase in perpetuity. It works the other way too. You get a few bad months of reads on resale prices and people think, well, real estate's flat or it's dead. But resale prices also increase when there's a relative imbalance between supply and demand. And so when we see that, we have relatively more buyers than we have homes. In resale, we tend to see some of that demand spill over into presale. So there's a very clear connection between those two markets for us in this region. And so against the backdrop of these lower rates, more resales, modestly rising home prices, we do expect presale counts in this region in total to move back towards their longer term average. Again, not a banner year for sure, but these numbers would be 25% higher than essentially what we're seeing, what we're on pace for this year and what we saw last year. So I think a lot to feel good about in some of those forecasts as we move back to a more normally functioning market. But I think the elephant in the room for many people is this mortgage renewal piece, with 2025 being the year that the pandemic mortgages renew. So I'm not going to talk about those with variable rate mortgages here. We know they've gotten their butts kicked over the past 2.5 years. And I want to focus more on those borrowers that have the 5-year fixed rates. So at the end of 2020, early 21, that's when those mortgage rates hit rock bottom, 1.5% or a bit lower percent. And then they increase over the next 3 years to 5.5%. So that's a 410 basis point increase, but nobody who originated at 139 actually had to face that music, right? If we want to look at what the impact is going to be for the renewers, we need to look at what obviously current rates are as they renew and the rate that they're renewing off of. The rate that they're renewing from is the gray line here. So currently around 2.5%, and the red line shows the difference between the two. And over the past 2 years, you can see that renewers are renewing into a higher rate environment. And so far, they've been able to afford it. So, but where do we go from here is the question. So we expect, for starters, that the 5-year fixed rate will stay in and around where it is today, plus or minus, subject to revision. What we do know is that by the end of next year, those renewers will be coming off ultra low rates. So what has everyone worried, including SpongeBob, is that differential in rates that we know is coming for many homeowners. And it is something to be concerned about from a macroeconomic perspective. But this is where we can thank the stress test, and I know we love to hate it. But back in December of 2020, if you look at a household that bought a home at $1 million and put 20% down, they're paying close to $3,200 a month. That's almost 32% of their monthly income. They were stress tested up to almost $4,000 and almost 40% of their income. Now, if we look at where they'll be in December of next year, their payments will be higher, absolutely, even though they've paid down their outstanding balance. So we're looking at about just north of $4,000 for their monthly payment, which is $850 more than what they were paying. So that hurts, there's no doubt about it. It is only $50 more than what they were stress tested at 5 years ago, and their incomes have gone up over this period by about 15%. So as a share of their income, their new payment is higher than before, yes, but it's actually below what they were stress tested at. So what this says to me, it's a lot, is just in a nutshell that higher rates are a pain in the butt, but they're not going to sink the market. It's just going to change people's spending habits, and it's going to slow the economy, but we can manage on average. Now, I'm sure you probably like that I shared some forecasts with you. Everybody loves a good forecast, but this is the time in the presentation when it is my duty to share this note that economic forecasting was invented to make astrology look respectable, and all of these forecasts are subject to revision. Okay, now looking forward, things will get better. I don't have much time left, so I'll move fairly quickly here. But in my view, the housing market here is on solid footing. And I want to speak to a few reasons why I think this is true, and they're listed there. It relates to mortgage-free equity, housing deficits, and also population growth. So this is the chart that Bob always jokes he made a career on, the mortgage-free equity chart. In this region, we have $450 billion of mortgage-free equity. This is just in principal residences. And it doesn't include, that dollar figure doesn't include anyone who has one more mortgage payment or has 10% remaining in their balance or whatever. It's only clear title. So it's a large number. There's two things that we know about this. Just to put it into context, if we look at that 75 plus cohort, they are the most, that group is the most likely to be sharing their wealth in the nearer term. They hold $112 billion of this mortgage-free equity in this region. So over the past 15 years, about $500 million of mortgage-free equity from this group has been released into the market. We don't know where it goes, but we just know it's coming from those households. It's a big number. For some context, it's 15% of the average resale volumes that we see in this region each month. So it's not a market driver, but it's definitely a market supporter. And that number is expected to grow over time. Now, I was having a little bit of fun with numbers here, but just to, again, put this number into additional context, that $112 billion could fund aggregate annual pre-sale deposits for the next 50 years. That's looking at typical sales counts across types and today's values. So these are big numbers, again, that don't drive the market, but support activity going forward. We talk about housing deficits. CMHC put out a report that BC needs to build 600,000 units over the next 6-7 years, above and beyond what we're already building, to get us back to affordability from 2003. That would mean almost 30,000 completions a year when we're completing at 40,000 a year currently. So obviously that's not going to happen. We just need a lot more housing. And we've been doing a pretty good job of building, there's no doubt about it, over the past few years. Last year in particular was a record year for housing starts in this region by a huge margin, by 18%. But the story's a little bit different again when you adjust for population. Most recently, even though we have been building a lot, our population's been growing a lot. And if we look at the number of annual starts on a monthly basis here per 1,000 residents, most recently, it's bang on that long run average. And we know that that number is probably going to start falling in the next couple of years because of what we've seen happen in the pre-sale market over the past couple of years. So supply is going to continue to be an issue, again, against that backdrop of growing demand. Housing growth, or population growth in Canada in 22 and 23 in particular, almost literally off the charts. This chart shows relative growth going to the right against absolute growth, and you can see the outliers that 22 and 23 are. And I think there's been a lot of talk about, a lot of acknowledgement, I think, especially by the federal government, that, hey, maybe we're going a bit too fast. Like, housing can't keep up, like healthcare can't keep up, our roads can't keep up. So now we're seeing some policies introduced and defined and talked about as they relate to international students, temporary foreign workers, and even permanent residents, and we'll have the new targets published by the federal government next month. They may look a little bit different than they have in the past, a little bit lower. So we're doing something about it, but we haven't done anything about it yet. And what's really interesting is this is sort of the population boom has almost become a secondary story, because I don't know if we're just acclimated to it, or we think that there's other stuff going on and this won't be an issue anymore. But through the first half of 2024, we added more people on a net basis in Canada than we've added in 47 out of the past 52 full years. That's this year. So we have a lot of people who are coming here. There's a lot of pent-up demand as well. We are growing not because we're having kids. We are not having babies. The fertility rate in this country remains below replacement, as it has since the mid-70s. And obviously, the reason we're growing is migration. It's 98% of our growth nationally. And without them, we would have more people dying than being born every year. And it's actually something that we're seeing in BC. So we're growing because of migration, and we know that migrants rent. So if we look at people coming to Metro Vancouver from other parts of Canada and internationally, together, more than half of them are renting within their first 5 years. And that compares to only 17% of non-movers. So my question then is, well, who's going to be renting to the renters? If we look back over the last decade and a half-ish, it's been the investor set. It's been the mom and pop investors, condo owners. If we look at the apartment condo space in rental in this market, back in 2007, a quarter of those homes were in the secondary market, and 3/4 of them were in the primary or purpose-built market. Now, fast forward to 2023, where that's the latest data, and that share is up to 44%, because over the past 16 years here, that secondary market accounted for, on a net basis, 4 out of every 5 additions into the condo apartment rental space in this market. This is a hugely important segment of our market, these investors. And unfortunately now the math for investors is downright ugly. This is just a cross-section of cash flow estimates for different neighborhoods in Metro Vancouver using current pricing data and rental rates. And these numbers do not make sense to a lot of people. You will have investors certainly that say, oh, I believe that property values are going to increase over time. Or they're going to look 5 years out and think, well, market rents are coming up, and I'll renew my mortgage then, and my balance will be lower and rates will be lower, and maybe then that makes it work for them. But for a lot of people, they won't be able to stomach this in the current economic context. And indeed, we're seeing this play out across projects that we are marketing and selling in this region. If we look at all of our projects, from townhomes to wood frame projects to concrete projects, 2021 through 2023, roughly half of those buyers were investors. Through the first half of this year, that number got slashed in half, so we're down to about a quarter. And in part because these investors many of them are staying on the sidelines, we're seeing fewer larger projects actually launch. If we look at projects, the number of projects that launched in this market in the first half of this year compared to the first half of last year, which wasn't a great year. We can see there's more wood frame, more townhome projects. That's great. But when we compare it to the first half of the past 10 years, we see that everything is lower, and in particular, concrete. So these larger projects are just not making it to market, and that is new housing supply that just isn't materializing. But part of the problem is interest rates, obviously. Part of the problem is market conditions, more broadly. Part of the problem is policy. I think the first two are changing for the better, and we have to do better on the third. Almost out of time here. I want to just circle back to this slide, where I'm coming from, and revisit these principles, starting with number 2. And that is that the economy sucks. The labor market certainly is not anything to write home about, but it is the canary in the coal mine that we need. Inflation has been vanquished, and that means that rates are going to come down, and they might come down faster than you think. We're never going to be Calgary, but affordability is improving, sales are picking up, and our market will return to something that feels like normal, which is to say things will get better. At the end of the day, I fundamentally believe in the intrinsic value of our housing market. Nobody needs a stock certificate or a T-bill or a fancy hotel or a Warhol, but everyone needs a home. So even though the perversion of being an economist is that I derive immense pleasure from predicting bad outcomes, I do hope that the good outcomes that I see here come to fruition. So that's it. Thank you very much.